Welcome to the Winner's Playbook with Steve and Josh. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book a free 15-minute call to discuss your personal situation.
Welcome back to the Winner's Playbook. My name's Steve Sloan. I'm here with my co-director and colleague Josh Lee, here to talk all about winning. Josh, we've had a rather big week. We've been travelling overseas internationally to see the team. Do you want to give us a bit of a rundown of how that looked this week?
Yeah, so we obviously just got back from the Philippines. So we were over there from about last Wednesday through to Sunday, and we kicked off our conference over in the Philippines on Friday, and that ran all the way through to Sunday. So it was sort of 2 to 3 days there. Action-packed, a lot of activities. Philippines culture definitely very different to Australian culture, so it was a lot of fun thrown in there. But yeah, we put on the conference over there with the team, and I suppose the big key theme of what we were going through with all of the team there is the concept of personal responsibility, which I think was quite new to the team over there. And by personal responsibility, I mean owning all of the outcomes in your life, not putting the blame on others, and really taking it by the bull by the horn, so to speak, and really getting after it. But yeah, I think it was good. There was some good key takeaways, I think. I think a lot of the team, and even for us, you always pick up something from hearing other people speak, and you take little bits and pieces away. And I think that's just one of the things that all the team members did, and got an opportunity, I think, to also reflect on their life and where they're heading as well. And that's a part of what we did over there with the business Lavera that we operate, is actually talk about a bit about the vision and where we're trying to take this thing, which is not where it is now, and we want to make it obviously a lot larger moving forwards. But the key theme being personal responsibility, I think was a good topic. What was some of your takeaways, Steve?
My takeaways, I think when I always go visit the Philippines, I'm always impressed by the people there. Immensely driven people, and got the great ethics and standards over there. I'm quite impressed. But I think for the listeners out there, Lavera is one of our businesses we've been building over the last couple of years, which is timely considering this episode's about diversification. But the reason why we built that business was really to diversify. And for those listeners out there that don't know about the business, it's a business that supplies staff to finance practices and businesses around Australia, and potentially around the world one day. But it's got circa 45 staff over there, I think we have, close to. And has been immensely successful. But you and I have some pretty big plans for that business. It's going to be exciting to watch. So for everyone out there who wants to have a look, go to lavera.com.au and take a look. But that brings us to our topic for today, which is actually about diversification, diversification in life. And we can talk about diversification in business a fair bit because we've done a lot of it. And I think I talk about this a lot. The Royal Commission came into Australia, circa 5, 6, 7 years ago, whatever it may be. You and I made a conscious decision at that point to really diversify our business interests across multiple different businesses that complement each other. And really, from that point onwards, I think we saw that we had to really diversify our group of entities to support each other, but also create those revenue streams. And we've successfully done that, I'd suggest, and created a great foundation for the future for these companies, Lavera being one of them, but then we've got Link Wealth Group being the other. We've got Link Wealth Finance and Link Wealth Accounting, which are our main entities. But what's your take, Josh, on that term diversification?
Yeah, it's obviously thrown a lot around in the spectrum of investing, in the world of investing. And of course, diversification, what does it mean? Just not putting all of your eggs in one basket, essentially, which is an interesting concept in itself. But in terms of diversification, predominantly we're talking here about investing and not putting all of your money solely in towards one venture. But then there's also people out there, like some of the biggest investors and most famous investors and wealthiest people in the world, like Warren Buffett, who kind of also has some quotes that you can Google, which basically means that diversification in some ways is for sissies in a way, is one way he sort of puts it. But I think diversification for your average investor is a good thing. And I guess there's two prongs we can look at that: is your average investor and people maybe involved in business who tend to concentrate a lot of their wealth through their businesses, and that's where there is a bit of that lack of diversification. But I think if you look at all of the truly wealthy people, they're generally involved in business, and therefore they probably scaled and built much of their wealth through their business, which is kind of the opposite of diversification, because you're basically pulling all of your eggs nearly into that one basket. And if that business fails, well, you start from scratch and you can sometimes lose it all as well. So that's probably on the real high risk spectrum. But that's where diversification for your average investor is really good, because you can sort of spread out your risk, not put all of the eggs into one basket. And if we're talking from an investing point of view, typically when we're talking about diversification, it's okay, how much allocation are we going to have in property? How much allocation do you already have in your property? What sort of other investments should we consider? Shares, ETFs, managed funds. How much allocation are we going to have in cash, term deposits, and things like that? Which all of that's just going to come down to your individual circumstances. But then you can also go a step further in terms of diversification in your life. And I think the big one there that you sort of hinted on before, Steve, was like other income streams, and that can go for business, but also in your own personal life. You don't have to run a business to have separate income streams. You might have your 9 to 5 or whatever it is where you get your main salary, but then maybe you do have some little side hustles that you do on the side, and that is a way of diversifying, not just being solely reliant on your employment, and actually spending some time building up some little side hustles, which we have spoken about on other podcasts before. But basically, just not being reliant on one sole source to govern your life, build your wealth, and produce your income. So, what are your takes on diversification, Steve? Do you like it, or do you not?
I absolutely do, but I also am, aware that most people, like, I wouldn't say I'm extremely wealthy, but I've done it right for myself, and really most of that wealth has come out of my business interests, and still today most of my wealth is in my business interest. And so, because of that, yes, I'm not diversified because it is really wrapped up in those 4 businesses, predominantly 2 of them, I suppose, that has most of my wealth. But then after that, absolutely, I diversify, right? Because I don't want to have to think too heavily about some of my investments. So I'm diversified in lots of ETFs and things like that are diversified in thousands of companies around the world and in Australia. And that's because I don't want to have to think about it too much and just gain that growth over long periods of time without having to really put in too much manpower, right? Because if you don't put in too much manpower, then you've got to diversify. Because if you're not going to look at it, you have to really diversify. And those investments are just set and forget. Don't have to think about it. And to do that, if you're not going to think about it, you absolutely have to diversify. But on the other side of the fence, where all my majority of my wealth is in the business, I'm on at 9 to 5. Well, you know, 7 a.m. to 11 p.m. every day of the year, 365 days a year. I've got my finger on the pulse of the business, and that is not diversified. But I can take that risk because I'm heavily involved in it, heavily on top of it. As soon as something happens, I'm there, so I can take that risk. But yeah, absolutely, I'm a fan of diversification in the right manner. But I think, yeah, look, to make a lot of wealth, you probably have to go all in on a particular asset, right? Whether that be business or a particular investment. Exactly like property, because if you buy a property, you're probably not diversified, right? Because you're buying one property. Something happens to that one property, you not, and a lot of people have made their wealth out of 1 or 2 properties,
Yep.
right? That have gone really well for them. Predominantly, maybe their main residence or something like that. But and that's probably classified as not diversified because you're buying one asset class and one asset in that class. But I think just the combination of all, of different asset classes at once you definitely have your wealth is key, because once you build wealth and you've got it, absolutely the second step is once you build that wealth is create those revenue streams. And that can come from multiple sources. It's better if it comes from multiple sources because you can capitalize on different movements in those asset classes. Some ETFs are paying higher dividend yields than others. That moves a lot, right? Over the years, markets move up and down. So you can absolutely capitalize on that, or the property market fluctuates. You can take advantage of that if you're in it, right, and move around in it. So yeah, I'm all for it, mate. I've built wealth in business, but I definitely diversify after that.
Yeah, I think it's a good point you mentioned about diversifying in single asset classes. Like if you sort of put business into its own, like we use, we said earlier, we've got various different businesses that sort of complement link and not being reliant on one income source there. But if you then talk outside of business, in property is not just it's an asset class, but then there's a lot of different ways you can go with it. And when I talk to my clients around diversification with property, what most people generally do when they get their family home and then they consider buying an investment property. A lot of Australians, generally do that. But the issue is, and there's a lot of statistics behind this, like most Australians, when they buy their next property as an investment, they generally buy within like a 40K radius of where they live.
Yeah.
So they buy there because they're comfortable with it, they know the area, and sometimes they think they're an expert and think it's going to go through major growth and it ticks all of the boxes. But when I talk to my clients about it, and buying property is usually a big part of a lot of the planning that we do because it's a great asset to hold for the longer term. The benefits of leverage and using the bank's money to acquire a total greater amount of asset, but you can still get that diversification then in the one asset class being property. By the way I consider it with my clients is, if you own your property, say in Melbourne or Sydney, whatever it may be, maybe the next one doesn't need to be in that same state.
Yeah.
Because I think the last couple of years is a great example of that. You look at Melbourne and Sydney have been quite similar in terms of growth and so on over the years, but now Sydney's really roared ahead. And I think Brisbane's actually overtaken Melbourne in
It has
terms of average house
average.
price. So Melbourne
Yeah.
property prices the last 2 years have done like nothing.
Yeah.
So if you had, and I actually seen one client not too long ago who had about 10 properties in one state,
Yeah. Wow.
and I see that as a massive risk. Where
Crazy.
when I'm speaking to my clients about trying to scale their portfolio, right? If you've got your family home in Adelaide, well then maybe the invest property is in Queensland or
Mm.
Sydney or Melbourne, because you're going to go through those periods of time
Yeah.
where the states, it's like the property market, it's like the share market. There's all these different um, areas and I suppose industries, you can call it in a way if you relate it to the share market, and they're all going to be doing different things at one time as well. So even if
Mm.
you are concentrating on one asset class, say business, well, you can have multiple businesses in
Mm.
business. In property, you could have different types of property, residential, commercial,
Yep.
diversify between all of the different states. And yeah, I think the last couple of years has been a really good reason and understanding as to why. Because like I've got my first home was in Melbourne, and that hasn't then really done that much over the
Mm.
last couple of years. Doesn't mean it's going to stay like that forever, but I think it really does highlight the importance of diversifying, particularly in property, because it's a big outlay that you are making. And if it's an investment property as well, there shouldn't be any emotional attachment to it. Like you're not living in the property, you're just trying to figure out where's the best place to invest, get the best bang for your buck for your money. And that's probably not going to be, in the next street over from where you are living. And if you're buying and investing like that, I think that's a huge risk, because everyone normally diversifies in the share market. It's quite easy. You just buy different ETFs or different managed funds. You have your international exposure, Australian exposure, maybe you've got some emerging markets, and it's very, very easy to diversify in the share market, but you can do the same thing in the property market. So I think that's definitely something that a lot of Australians could probably learn from, because I see a lot of people that have got their property and then a stone's throw away is
There's
property number
more.
two. And then
Yeah.
what if infrastructure changes,
No,
some
totally.
social housing goes up in the area, and it's
Or,
I think
or,
it's
or
a
the
I think
big,
it's a
or the
huge
big
risk.
one, or the big one being government changes the rules, right? So,
Yeah.
and we've seen that evidently in Melbourne with the taxes that they just landed on
Yep.
property investments. So, if you've got all your property in Melbourne, you're probably feeling a
Oh,
lot of pain right now, right? So,
totally, totally.
yeah,
I've seen it with some clients, and they're getting whacked with these huge land tax bills, like
yeah,
eye-watering stuff.
yeah,
And then now they're being forced to change their strategy, sell the
crazy.
properties. Whereas if you
Mm.
didn't sort of concentrate too much in one area, well, you ultimately have that, and you can dig deeper in terms of diversifying
Yeah,
between structures, like not just in
yep,
your own personal name, trust, self-managed super fund. Maybe there's company structure, and you can really dig down in and get quite granular with it, I suppose. But what about for different stages of life, Steve, and diversification? And you hear the term risk profile thrown around, like if you're in your 20s and 30s, what you're probably going to be doing versus if you're in your 50s and 60s is going to be a little bit different. Do
yeah.
you think that approach to diversification changes there, or the same principles really apply, depending, that doesn't really matter on age?
I think it's same principles apply. It really depends on the individual one. This one, like if you've got plenty of cash to, and I was going to go a bit deeper, saying diversify between liquid and illiquid
Mm,
assets is also key, right? Because you've got to have liquidity in asset classes if you need to pay the bills. So,
yeah.
and you do that through managed funds, ETFs, shares, etc., but still grow. But then property is illiquid; you can't really sell
Yeah.
quickly. So you got to have that balance and diversification too, right? And I think that's the key part, because if you've got the cash in the bank, you've got access to capital to pay the bills. Well, you can keep retaining growth assets, because if you've got a couple of years of money to pay the bills, well, you don't need to liquidate assets if you've got money there to pay, right?
Yeah.
So yeah, that's a tricky one. A lot of people and a lot of advisors go there and say, risk profiles should change dramatically over the course of the journey when you go to retirement. Well, not necessarily. If that individual comes and they got plenty of liquid assets accessible, you might stick a little bit more cash in the bank to just make sure that the bills are covered, But if we've got plenty of ETS managed funds and shares and stuff, and I can sell them within 3 days and get the cash in the bank, well, I stay invested, right? So that doesn't change my risk profile. That just means I've got more access to capital when I need it. So yeah, it's I think it's person to person. That one really is individual. That's where advisors can really add value, right? Because it's, if you think, if you don't get the right advice, you then liquidate all your good assets, stick it in a cash bearing account, earning 5 or 6% when it could have been growing at 10.
Yeah.
You got to balance it out, but then there's also taxation consequences and everything else comes into it that we've got to consider at the same time. So it is definitely a person to person, that one.
Yeah, and I think if you've got a higher risk appetite, that's where you might probably be not diversifying as much, which no, you can't really get as high risk than business, where you've virtually got all the pennies on the line, and if the ship goes down, the whole life can nearly go down with it as well. So, but again, with that risk comes the highest reward as well. So
that's right.
It's going to be completely different for absolutely everyone. But in closing, guys, hope you're getting some value out of this. And give us 5 stars, Spotify and Apple. It does help us a lot. Check the show notes. Check our socials out if you're always wanting to check out and get more bits and pieces of wisdom, not just from Steve and myself, but all of the advisors at Link Wealth Group are actually on social media, TikTok, Instagram, Facebook, LinkedIn, etc. And if you do want to chat about your personal situation one-to-one, as always, you can go on the website, 15-minute chat at no cost, and we can actually talk about your life and maybe point you in the right direction as to what your next few moves look like. So Steve, we'll wrap it up there, mate, and I'll see you on the next one.
See you next time, mate. Bye.
Ciao, ciao. Bye.